Hey everybody, today we are going to go over what is a falling wedge using technical analysis in the financial markets. So a falling wedge is something that essentially is really just two basic trend lines or trend zones depending on how you draw your resistance or support. I personally like to use zones because just using a simple trend line definitely can make things a little too precise, and you can definitely miss out on moves simply by just looking at things in way too much of a detailed manner. A trend zone really allows you to look at a general area rather than that exact point. So I actually have made a video on this on the Optimus Futures YouTube. So if you do want to look more into how to create trend zones rather than trend lines, you can definitely check out that video. So the first thing that is really kind of a misconception about falling wedges is they are not always bullish. And that goes for any setup in the market. You can have a setup that has a technical statistical bias. And what I mean by that is if you're looking at any technical setup, generally you're going to have something that has more of a bull bias or a bear bias. That means that more than 50% of the time, you generally get a break to the upside or the downside. In this case, a falling wedge is definitely more of a statistical bullish bias, and a lot of the time this is signaling a potential reversal in the market. So in this case, we're looking at the micro contracts for crude oil. If you do want to trade other contracts on Optimus Futures, you can trade micros on ES, NQ, RTY. So Optimus Futures is definitely something that you can use for your micros trading. In this case, this was just a great case study looking at crude oil on the micro side of things, and that's what we'll be looking at here. So what I did was, and if you want to just follow the arrow here, what I did was I initially started my falling wedge pretty much from this point here, and what I did was I extended it over and to capture this general area here. Now you can see here that in this particular candle from November 15th of 2023, this is really where we established a low. So what I do is I'm connecting the wick of this candle from, excuse me, from August 2nd, and then I'm essentially connecting this wick here from November 15th. Now notice that you do have some price action, that you do have a bounce in this general area. So you have 1, 2, 3 points here that are creating a falling wedge support. Now, the way that I created the zone here was I essentially just took an original trend line connecting these two wicks that we just went over, and then I'm using essentially the channel indicator here, the channel tool, to connect this wick here from August 24th of 2023. So this is what creates this general area, and notice here that you can see that the wick in the body here, that's exactly the same width as if you connected the wicks here and then extended this to this wick here. So not only are you making the trend zone a function, the width being a function of this wick here, you're also kind of creating this trend zone as a function of the wick to the body of this candle. So if I am doing trend zones, I generally will connect the wick to wick always. You're always connecting two wicks for the outside part of the trend zone, but then on the inside you're generally connecting wicks or bodies of candles. So in this case you can see here this body here, and then this wick here create this general width of the support zone. So then if we go to the resistance zone, same thing. I'm connecting this wick to this wick here. I'm extending it. You can see that after we connected these two wicks here, we did have continued resistance for multiple days before we finally broke out. So the thing to always remember with a falling wedge is generally you're going to at least retest the breakout zone, and that's for horizontal levels, that's for diagonal zones, but a lot of the time you'll get a 1 to 2 candle impulse move to a target area. So what exactly is that target area for a falling wedge setup? So if you have a breakout of the falling wedge setup, you always want to anchor a volume weighted average price. So this is the VWAP pretty much starting from the resistance start point of the falling wedge. So you can see here that this is where we started. This is essentially a pivot in the market from October 19th. And you can see here that this is the VWAP that I'm using. And after we broke out, first day we broke out, second day we pulled back, continued up, and then our third day we hit the anchored VWAP almost to the T. So you can see here that at this point we're starting to pull back a little bit. We're retesting once again this resistance zone, and this is something that happens more than not. And as I mentioned, this happens for pretty much anything. If you're using a VWAP as resistance, let's say that we broke out of this VWAP, broke out, generally you're going to get a pullback to at least retest that area. That's just a healthy breakout. Generally, if you get a breakout and you just continue to move up, you're generally going to get a pretty strong move to the downside as well, simply because everybody starts taking profits after such a big move. So when you have these kind of short-term moves up, pullbacks, you kind of reset the market. So this retest of this resistance, pretty much flipping from resistance to support, also known as an SR flip, is generally very healthy and welcomed, right? You want to have the market reset a little bit. You want people to take profits and then kind of reset where the break-even point is for a lot of traders. So this is really how you can utilize a falling wedge. The main thing, as I mentioned, the main misconception here is that a falling wedge immediately means that you're going to have an upside breakout and that it's always bullish. That is not only incorrect for falling wedges, it's incorrect for ascending triangles, descending triangles, any setup you really have. And really the trigger for this setup is simply just the break. If you break to the upside, and you have to keep things systematic, if you break to the upside and close above the resistance zone, then you have an upside breakout confirming the move to the upside. And then, as I mentioned, your target is that VWAP from the start point of the falling wedge resistance. Now, if you break down, in this case we're looking at a daily candle, if you break below and close below the support, then the falling wedge is invalidated for a break to the upside. I've seen plenty of falling wedges break to the downside, especially when rates were going up in 2022, even into 2020, late 2021 into 2022. You had things that just constantly were breaking down. Even though you had falling wedge setups, they were constantly breaking down because the market was just extremely weak due to the fact that the Feds were raising rates and you were just really having a hard sell-off across the market. So this is definitely something to consider. You have to use that if-then for any of this. If you break and close above resistance, then your upside target is initially the falling wedge resistance. And you always have to essentially look at these things in incremental analysis. We don't know what the next upside target is until we have a daily close above this VWAP. Now, if we did have a daily close above this VWAP, this previous support zone here would then be your next upside target. So in this case, if we want to use just a basic rectangle here, we can draw across here. And notice that I'm doing the same thing, right, with the horizontal level. I'm starting with the body here, and then I'm essentially creating the width of this zone as a function of this body, the start of that body, and then this wick, and then we just extend it. So you can see here this initially was support, it flipped to resistance, we continued down. So then if we did move to the upside and break and close above this VWAP, then the next upside target would be this horizontal zone here. So as I mentioned, everything really has to be systematic. If then, that really helps remove the emotions and really helps you keep some type of system in place and a rule-based system in place, which can really keep things a lot more data focused and as I mentioned, if then focused, rather than saying, oh, I think it's going to do this. No, if we close above this, then the next target is X price. So hopefully this video is helpful understanding what a falling wedge is. And one thing that I wanted to mention before I end this video is generally you're going to look for a breakout or breakdown as you get close to what's called the apex of this setup. So as you get closer and closer to the apex, i.e. the end of essentially where the resistance and the support zone meet, that's generally where you're going to get your trigger. And a lot of the time, it's a lot more helpful to not just look at price action. You can also look at lower indicators. Let's say that the MACD is starting to curl to the upside and you have price near the falling wedge apex, then that is generally giving you more ammunition for a reason to be bullish. So it is great to use these setups with lower indicators like the MACD, which is generally looking at trend reversal. You can use the RSI, the Williams percent range. I've made a video on these lower indicators as well on the Optimus Futures YouTube, so you can really check that out as well. So as I mentioned, hopefully this was helpful. Hopefully you learned a little bit about the falling wedge and that it's not always bullish, but it does have a statistical bullish bias, meaning that more than 50% of the time, you generally get an upside break in these versus a downside break. Everybody have a great one. Thank you for watching, and make sure to watch out for other videos coming your way.